Hey guys, welcome back. Um, I did something interesting in some research earlier this week. I thought I would try to do a portfolio that pays dividends as frequently as possible. So to do that, I took stocks that pay monthly and stocks that pay quarterly dividends, and I tried to find dates that weren't all lined up on top of each other. So with the 12 stocks I selected, you'd get an average return on dividends of about 13%. And get a payment almost every week. I think there's 2 weeks where you wouldn't get any, and I just stopped looking at that point. I apologize, but I thought I thought the investment of time had run its course. Call me lazy, but still, the idea was to find good dividend-paying stocks, so companies that pay and grow their dividends regularly or have in the past, and have not stopped paying dividends through recessions and economic downturns. And with the exception of two that I'm going to explain on the laptop, I did that. So for younger people who don't have vast sums of money to invest, for whom it seems like a very long time to wait for a whole quarter, a whole 3 months to get $23 in dividends to be motivated, like that's your dopamine kick every 3 months. I tried to change it so you get a small dopamine kick every week, and definitely at the minimum every month, but multiple times a month. So anyway, we're gonna go over to the laptop and I'll show you the spreadsheets, the stocks, run you through what the companies are and what kind of returns you could expect depending on how much money you put in each. So let's start with the tickers. The first one here, DGS, is a split fund in Canada of, I want to say, the 50 largest Canadian companies. And before we go too far, a split fund is kind of like an ETF. They buy a bunch of stuff, they package it all together, and then they split it in two, and each stock gets a value of $10 typically. You have the preferred stock and the common stock. Preferred means the price will rarely ever go up or down, and it will pay pretty much a guaranteed 5% dividend. The common stock, on the other side, will pay all other proceeds. So it will take all of the appreciation, if there is any, and it will pay all of the other profits. But if there's a downturn economically, the preferred stocks will be devaluated and potentially the dividend will stop to support or make sure that the preferred share keeps getting its dividend and its price stays the same. So in this case, we took the riskier of the two. It's a common share, which pays 19% dividend right now based on the $6 price when I looked at it anyway. The next one up, TAL, is a petro company in Canada. They're involved in various activities for the petroleum industry, I think extraction, refining, transporting, and so on. They're pretty cheap right now at 83 cents. They also have a decent PE, if I recall, but the 13% dividend was what attracted me to put this on the sheet. SBC is also a split share, much like DGS. However, in this case, it is the top 6 banks in Canada that are composed of it. Same thing, it's the common share in this case. Preferred would yield 5% dividend. The common yields 12.99 right now. MORT is a mortgage company, I believe out of the US, self-explaining. DKL, I can't quite recall just off the top of my head. ALV is a petro company, again, out of Canada. SRU is a commercial real estate in Canada. They pay, well, it's a right. And a quick note on that. Rights have to pay, I think it's 90% of all their profits to their shareholders throughout the years. So all real estate investment companies like this, or real estate investment trusts rather, will pay pretty good dividends because they have to. NHTC operates in the medical healthcare sector. Can't quite remember off the top of my head. Med, same thing. I think it's a lifestyle or healthy living thing. DOC, I want to say, is the commercial management of hospitals or clinics. Can't quite remember CTO. And MO is smokable products, tobacco, and so on. Probably vape pens. I'm not sure exactly their entire product line, but that's their market. Now, I'm not saying anybody should buy any of these. It's one that I fictitiously constructed. It's a list that I just picked out because these companies have a habit of paying very healthy dividends on an ongoing basis and have done so for quite a while. With the exception of DGS, which suspended dividends last year, I want to say for 6 months or so, during the economic uncertainty. Let's call it that. Okay. Now, for the interesting part. So here I put it at 1,000 invested in each of these stocks. So 12,000 as your, let's say, startup. And you can see on the side the dividends that you would get, in some cases every month, in some cases quarterly. Note that they're mostly all staggered. So you would get a dividend almost every week out of the 12-week period for the quarter, missing, I think, only 2. And because of that, you would get a very steady cash flow. If you look at the bottom here, we have January, February, March, 100, 118, and 125, and then it repeats itself because it's quarterly, which gives you an average of 1,484 per month and 1,378.02 for the yearly return. So roughly a 13% average return, 13.7, I guess. And what's interesting here is if you compound this, obviously, or if you reinvest it through the year, then you'd have an extra 1,000. But if you doubled it, so let's say you did the same thing for 2 years and had $2,000 invested in each, and you have a very clear doubling of the pattern. I haven't built the formula here to take into account the extra 1,300 spread out over this, but it would be a little bit more than that. And as you can see, an extra 100 per month is okay. It's not, not life-changing. An extra 200 starts to make a difference. And if you can do that for, let's say, 4 years, and you reinvest the dividends, you'd be probably up to 5,000 invested in each. Now you're getting, 500-600 a month. Yeah, that's enough to make a difference, I would say, for most people. So you'd have a portfolio of 60,000 invested. You'd get a return every month in cash of 500,000, depending on if this is a TFSA, a Roth IRA, or a regular investment account. You would either benefit from no taxes at all or very, very low taxes, which apply to dividends. So anyway, there you have it. I'll post this spreadsheet up in the description. So if you guys want to play around with it, you can do so. And there you go. There you have it. Nice little way to build either your portfolio or a section of your portfolio to get dividends frequently and have cash flow, right? You can reinvest a dividend, but on any given month, if there's a downturn for yourself, yeah, take the dividend and pay whatever you need to pay with it. Without selling the underlying asset, obviously. And also, you can change out these companies. Those are the ones I picked. Obviously, there's tons and tons of others. Just try to take blue chip type companies that have paid dividends for a long time. Don't have a habit of either cutting them or stopping them, but rather growing them. And yeah, you should be fine. You'll probably get a trickle of cash all the time. Keep in mind the portfolio appreciation in this case is on the meager side because of the cash flow transition, right? All the cash is coming to you. So the stocks won't go up very much. Some of them actually won't go up probably at all over a 5-10 year span. I would say probably just under 4% appreciation is what you saw in the last 10 years for all of these, or if you had this portfolio for the last 10 years. And so taper that expectation. It's probably going to appreciate and meet/just beat inflation, but not much more than that. Anyway, thanks for watching. Please subscribe.